of 2minds.com. Charles Hugh Smith, which is also his other website. He has both, charleshughsmith.blogspot.com or of 2minds, all spelled out, .com. The global financial system is unraveling, and no, the U.S. is not immune, he says. Currencies don't melt down randomly. This is only the first stage of a complete reordering of the global financial system. Talking Argentina, Venezuela, which has been on for a while, Brazil's in trouble, Italy's in trouble, more recently, what was the other one? Argentina's in trouble. And there's, I think even India, same with India. As far as their dollar, dumping, all of them, their currency. Currencies don't melt down randomly, is what he's saying. Take a look at the Shanghai stock market, China, and tell me what you see. Which, in case you have a hard time looking, I'll put it up for you real quick, right there. A complete meltdown, right? More specifically, a 4-month battle to cling to the key technical support of the 200-week moving average, which is the red line here. Once the support finally broke, the index crashed. Meanwhile, the U.S. stock market seems to be running the show for some reason. A complete meltdown. Anyways, now take a look at the U.S. S&P stock market. It was on the same screen, but I'll pull it back up again for my people. The SPX is soaring to new highs. Not just climbing a wall of worry, but leaping over it. So the engine of global growth, China, is exhibiting signs of serious disorder, and the world's consumerist paradise, the U.S., is on a euphoric high. The divergence is worth pondering. How can the two economies that have powered a 28-year bull market in just about everything, setting aside that spot of bother in 2008 and 9, be responding so differently to the global economy and global financial system's woes? There's a rule of thumb that is also worth pondering. While the stock market attracts all the media attention, every newscast reports the daily closing of the Dow Jones Industrial Average, the SPX, and the NASDAQ Stock Index. The bond market is larger and more consequential. And larger still is the currency market, as in Forex, FX. As the chart below illustrates, which I guess I'll get to in a minute, because I still don't even see it where I'm at, a great many currencies around the world are in complete meltdown. This is not normal. Nations that overborrow, overspend, and print too much of their currency to generate an illusion of solvency eventually experience a currency crisis as investors and traders lose faith in the currency as a store of value, i.e. the faith that it will have the same or more purchasing power in a month that it has today. Ask Venezuela how that worked. Ask currently Argentina how that's working. Very bad if you ask them. I'll go ahead and save you the time you need to go ask them. Okay, got you. J Snip's got you covered, son. Where was I? Here's the key takeaway. A currency crisis is a symptom of a deeper disease, if you will. It's not the illness. The same is true of stock market declines like the Shanghai Index that breaks long-term support levels. A crashing stock market is a symptom of a deeper disease, if you will. It's not the illness. The fact that so many currencies are melting down at the same time is telling us the global financial system is unraveling, and unraveling fast. This is a symptom of a fatal disease. Currencies reflect all sorts of financial information. They're akin to taking an economy's pulse. Trade balances, debt levels, interest rates, central bank policies, fiscal policies, and so on. The global financial system is interconnected, but this is not a viable excuse for the meltdown. The general explanation floating around is that currency weakness is like the flu. One currency gets it, and then it spreads to other weak currencies. The diagnosis is misleading. What's actually happening is the unprecedented global bubble of debt and assets of the past decade is popping, which remind me to do another video after this. Actually, you don't have to. I already got it set. Average U.S. rent hits all-time high of $1,412, biggest increase in 18 months. What usually happens when a crash of whatever economic indicator, not indicator, but stocks, housing, credit, whatever it is, whatever you're looking at, what's the final thing you see normally? Like that, the last thing you see, I should say. And I think I'm zoomed in a little too close to my face. Feeling a little disturbed by how close I am to that camera. Hold on. Wait a second. Let me open this baby back up and zoom out one little hair there. Another one. This way. This way. Well, there we go. Scoot over a little bit. What do you need? See my mic dipping up in the corner down here. It's all right. Push the mic down here so you don't even see it. See, that's magic. Jason Nip 4 magic. Well, where were we? Move this camera controller out of the way. So, what's the last thing you see? An all-time high, right? Oh, there's the sign. Dip past the 200 moving day average. That's gone. Okay, we're in trouble. But usually by the time it gets there, all the big profits have already been taken. Like, oh man, I wish I would have got out over there. Or, I wish I would have sold my house over there. Too late. So, rent, all-time high. Housing again. Real estate, all-time highs. You follow me? Some places have peaked or starting to pull back. Most haven't yet. They're still at the peak or peaking. And seems like a perfect recipe for disaster. And a very awesome recipe for high cryptocurrency prices in the near future. But who am I to say? Where do we go from here? Where do we go from here? Now that all of the economies are blowing up. Got to figure out where did I left off. Trade balance. The global financial system is interconnected, but this is not a viable excuse for the meltdown. The general explanation floating around is that currency weakness is like the flu. One currency gets it, then it spreads around. Remember that? The diagnosis is misleading. What's actually happening is the unprecedented global bubble of debt and assets of the past decade is popping. And it's laying waste to the most indebted, over-leveraged, and mismanaged nations first, either via stock market declines or meltdowns in currencies. These are symptoms. The disease is the fixes of the past decade, extreme expansions of debt and asset valuations. Right? Extreme expansions of debt and extreme asset valuations. 1,400 something dollars. And that's probably for a one-bedroom, like, flat, where you have a bedroom, kitchen, everything's all in, like, one room. Little studio. There you go. Studio. No. Not the 80s jam. Quite possibly the next house you live in. Crampton. Unless you play your cards right. I'm telling you, my cryptocurrencies are my cards that I'm playing, so to speak. Just in case what I read to you constantly actually is true and means something, which I think it does because I wouldn't be reading it to you if I didn't. And some interesting times are coming around the corner. That may not be too good for some people, but for those of us in crypto, we hope it's going to be really good. Because this right here I'm reading you cannot be dealt with. Like, oh, we'll just flip a switch and it's all good. Don't worry. Higher prices, everything's going to go, No. As a Big 10-4, it is not happening like that. These things have to deflate. Assets, deflate. Market prices, deflate. Not to say we can't go on another tear up on the stock market one final time. Let's go, baby. Push, pump. Before the big one hits. Who knows? These are symptoms. The disease is the fixes of the past decade. Extreme expansions of debt and asset valuations are unraveling. The global financial system suffered a seizure, so to speak, in 2008 and 9, a non-linear manifestation of a system completely out of whack. The $500 billion subprime mortgage market almost took down the entire $200 trillion global financial system. Right? So $500 billion can take down a $200 trillion system. Yeah. That's the acme of a brittle, fragile system. A small input, subprime mortgage defaults, yields an enormous output. global financial meltdown. How about global thermonuclear war? Greetings, Professor. Shall we play a game? I was going to play market meltdown. How about that? How about global thermonuclear war? Now, can we just play the market meltdown game where I take $500 billion, destroy the world with 200 trillion? Warp. Remember this, your computer's name. Warp. Joshua. Greetings. What nobody dares talk about is the fixes have made the global financial system even more vulnerable than it was in 2008. The global meltdown of currencies is evidence that the symptomatic solutions to the brush, with collapse in 2008-9, skyrocketing debt, and asset bubbles now, fixed nothing. Nothing. All they did was inflate an even larger, more vulnerable bubble, which we all said back then. You're only going to create a larger bubble that's going to be more devastating. Is it going to pop this year? Is it going to pop in 2019? Is it finally 2020? See, that's the things that we can't sit here and answer. But know that it's coming because we see what the fixes are. A bunch of band-aids that did nothing but made the problem worse. Currencies don't melt down randomly. This is only the first stage of a complete reordering of the global financial system. A reordering that will reprice all the assets currently bubbling at absurd levels to much lower valuations. So here's the chart they want to talk about. I'm going to put that up. Venezuelan currency, Sudanese, right here's a bunch of them. Year-to-date change, 100% down Venezuela, 61% down Sudanese pound. Argentina, we heard about them recently, 50% loss in their value of their dollar. The Turkish lira, 44%. Angolan kwanza. What could you get for a kwanza? A kwanza. That was wrong. I apologize for that. 38.8% down. Brazilian real, we just talked about them. 20%. Liberian, 18%. And a bunch of others, 15, 15, 10, etc. Indian rupee, 10%. India, for crying out loud. The illusion that the U.S. is immune to the unraveling of debt and asset valuations won't last. When the defaults start piling up, so will the losses. And when asset bubbles pop, incomes and spending decline every single time. Although few seem to notice, almost half the profits of the S&P 500 corporations are earned overseas. How's that baby going to continue to roll up? The belief that the U.S. markets are somehow disconnected from global markets and immune to the repricing of risk, debt, and assets and currencies is magical thinking. So, it's a great article from Charles Hugh Smith, the man, the legend. I'll put a link up. Take care.